So good afternoon, ladies and gentlemen. It's a pleasure to welcome you on behalf of our law firm, Keller Alskar, on this webinar entitled Board Liability and M&A Transactions in Difficult Times. I will introduce the topic with my presentation related to the board duties and liabilities in times of COVID crisis. Then my partner, Emmanuel Detwiller, will follow with a focus on the specificities of distressed transactions. Our associate, Cindy Hung, will act as moderator for the Q&A session, which will follow both presentations. And please note that the webinar will be recorded. The purpose of this presentation is to identify the principle that should govern the board actions in financial crisis, such as the one we are going through, particularly in the context of so-called distressed transaction designed to financially reorganize the company or to manage a liquidity crisis. I will introduce this speech by briefly mentioning the existing and foreseeable consequences of the current crisis on the economy in general and companies in particular. Generally speaking, COVID had an important impact on the economy on a global scale. As it can be seen on these graphics of the SECO, the Swiss GDP has strongly decreased in the second quarter of last year. And such decrease is also reflected in the graphic of the consumption climate. Prognostics for the beginning of this year are rather pessimistic due to the second wave and the recent lockdown ordered by the government. COVID has and will obviously have a deep impact on business as such, considering the following factor. First of all, the lockdown has an impact on closed businesses like catering, culture, sports, industry. Closing of shops and businesses lead the consumers to turn over e-commerce. Productivity will be impacted, considering also the short time working or even the shift to remote working. And due to the economic recession, there will be a decline in exports, which in turn has an impact on the supply chains as well on international sales. As reflected here, not all industries were impacted on the same level. Some were more strongly impacted than others, like for instance, the hospitality industry. SMEs are exposed to great stress, like service providers or the manufacturing sector. Generally speaking, a crisis can affect the company's strategy, profitability, equity, or liquidity. In normal times, crises often follow one another, and their severity increases in the absence of an adequate response. In the current context, however, many companies are quickly plunged into a financial crisis affecting their liquidity. And the company is threatened with insolvency, cannot meet its current expenses and short-term commitments. Insolvency rarely occurs without causing over-indebtedness. In this context, the discussion will now focus on board duties to face such financial crisis. Among the core duties, so-called inalienable duties of the board, some are particularly in demand at the heart of the crisis. The overall management of the company, the organization, the financial control and planning, the identification of potential over-indebtedness. Recent revision of the corporate law has introduced an explicit duty of the board to monitor the company's liquidity and to take appropriate action in case of insolvency. Such an obligation, in our view, results already from the competences described by current law. In its financial control, the board has to be aware of two alarm bells resulting from the balance sheet. These alarms will dictate the time and timing, the type and timing of action that the board can or should take. The first alarm bell is triggered when the last annual balance sheet shows that 1/2 of the share capital and the legal reserves are no longer covered. In that situation, the board must convene a general meeting and propose financial restructuring measures. The second level of emergency is triggered when there are serious doubts that the assets no longer cover debts. Shortly said, if the company is in a situation of over-indebtedness based on going concern and liquidation values without any possible subordination of debts, then the board has to notify the judge immediately, or at least should concrete and realistic measures be at hand to cure the situation within a grace period of time not exceeding 4 to 6 weeks. The boards must react quickly. Indeed, when over-indebtedness has increased between the time when bankruptcy should have been ordered and when the company was effectively bankrupt, the damage is calculated by comparing the balance sheets at liquidation value. And if there is delay in the notification, the board members assume joint and several liability for the damage incurred by the company and its creditors. In a financial crisis, the board has limited powers of action. He may take organizational measures like change of management. He may take accounting or financial measures. In this respect, the sale of assets is a sanitation measure frequently used to overcome a liquidity issue. But as reflected here, there are many situations where the participation of the shareholders or of the creditors in the remediation measures is necessary, like capital or credits restructuring. And it is seldom indeed that other players are not involved in the process. Let's consider now how the board should proceed to set up a sale of assets as a sanitation measure. The sale of non-operating assets makes possible to generate cash, and if the case may be, to realize hidden reserves. This will improve the situation both from a liquidity and an equity point of view. In this example, assets are booked for 200,000 and are sold for 500,000. Cash and equity will increase without any impacts of the loss as such. Who is competent to decide on the transaction? The sale of the company, the sale of the company's assets falls under the activity of managing a company as per Article 706 of the Code of Obligations. The transaction can therefore be decided by either the boards or the management. However, if a transaction reaches a magnitude that is of strategic importance for the company or its financing, the transaction in questions falls then within the scope of the core duties of the board. Moreover, the sale of assets might qualify as a liquidation or a partial liquidation of a company. This happens when a large part of the assets are being sold, which lead to a strong reduction of the company's activity or even a factual change on the company's purpose. In that situation, or even in the case of doubt, because it's difficult in practice to identify what a de facto liquidation is, the transaction will have to be approved by the general meeting of shareholders. Otherwise, such transaction might be null and void and can be reversed by the bankruptcy state. The Federal High Court allows one exception in case of emergency. If the company is over-indebted and if the general meeting is unable to act in due time, provided that the sale is interested of the employees and creditors. What are the interests to be taken into consideration in the decision-making process of the board? In a financial crisis, the board has a real obligation to take the appropriate measures to secure the existence of the company and to actively seek for restructuring solutions. In application of the business judgment rule, the boards shall mainly set up a suitable decision-making process in the interest of the company, gather all necessary information with assistance of experts, consultants, if necessary, take any and all measures to avoid or at least limit conflict of interest, especially if the transaction is negotiated with an affiliate. Against this background, the board of directors has an extensive discretion power in the decision-making process. In the context of an asset deal, that means that the transaction must be in the interest of the company. The transaction must achieve the highest possible price, and the board should take into consideration time frame and publicity, due to the fact that if the financial concern becomes public, the trust of customers, suppliers, and employees can be disrupted, which can result in declining customer order, stricter payment terms of supplier, or even termination of employees. And if a sale fails to be carried out, the search for a new buyer and the purchase price to be agreed with it might be impacted. I just mentioned that the board has an extensive discretion power in the decision-making process. However, there might be restrictions on such power to be considered in a crisis situation. As reflected in this graphic, the closer the company gets into over-indebtedness, the more the interests of creditors have to be taken into account by the company. Contractually, this influence can be based on agreements that offers creditors a right to information or even a right to influence the company's decision in case of financial difficulties. But even without contractual rights, creditors are protected even before bankruptcy by the anticipated effects of the clawback regulations, so the avoidance claims, revocatory claims, and the needs of the boards for their assistance in the reorganization operations. The Swiss federal law on debt collection and bankruptcy provides a general mechanism to reinstate assets that were unduly removed for the company before bankruptcy in breach, basically, of the equality of treatment of creditors. Without going into details of the regulation, it should be noted that a transaction performed as a remedy to a financial crisis might fall under the scope of this regulation. For example, the risk may be that the board has to proceed with the sale of the assets in a very short period of time and will not have enough time or leeway to negotiate a fair price at cash with a cash consideration. And then the risk lies in the validity of the transaction, as well as the civil or even criminal liability of the board. And this is, in our view, a major issue in the negotiation and the closing of an asset deal when the company is in financial difficulties. This legal background has an impact of the sales process, being a public auction or a private sale. Each approach has its pros and cons. Auction offers the advantages to reach an unlimited number of potential buyers, to achieve a fair price, the best possible price. But this might trigger a negative publicity or be a too lengthy process. Private sale offer the advantages of the discretion of the planned transaction, to avoid competitors, to have access to the company's assets, to choose rapidly a good fit for the assets to be sold, but the private sale cannot necessarily ensure a fair price. So to set up the risk management rules for distressed transactions, we would recommend that the board comply with the following requirements. First, to follow the best M&A practices in the sale process. Second, to set up a fair price process mandating an independent expert in the case of private sale. Third, to avoid any other consideration that immediate available upfront cash payments. To disclose company's financial situation to the buyer if this is required by good faith. To check the solvency of the buyer and to seek judicial protection if needed. COVID loans might be part of the restrictions to be considered by the board for the transaction. COVID loans have been granted in order to help companies to overcome the cash flow difficulties, which are the economic consequences of measures to fight against the COVID. Therefore, the COVID loans can only be used to cover ongoing costs, particular rent costs, operating costs, and so on. Among the limitations, the borrower may not distribute dividends nor refinance pre-existing loans, save for pre-existing obligations. Such limitations have to be considered as they might limit impact either the structures of the asset deal, which has to be governed by the Merger Act, or the modalities of the consideration. And please note that the board members might be personally, severally, and jointly liable to the creditors of the company, the lender, the surety organization, or the confederation for the damage they might cause by breaching those rules. Is it better for the board to appeal to the judge to prevent the risks and limitations that have just been exposed? If a financial turnaround is possible, then the board may proceed with either private or judicial steps. Private steps consist of finding agreements directly with the creditors. The board is here exposed to the avoidance claims, so to the clawback risks. Debt restructuring moratorium is a judicial proceeding, which in our view offers an interesting pathway for the board in order to protect its liability. The advantage of such moratorium compared to a private reorganization are multiple, in particular under a liability perspective. The company may proceed with a so-called pre-pack transaction, which is a mechanism not provided in the legal provisions, but which is often admissible in practice. The board should demonstrate that the sale is urgent and that the sale appears as such as the best possible way to protect the interest of the company and of the creditors. The transaction can be negotiated and even signed before the judge is notified, and the contract will be subject to the moratorium and to the approval of the sale by the courts and by the trustee, if any. If these conditions are met, there are no clawback risks anymore. In this proceeding, the creditors do not have the right to be heard. However, their involvement is a factor favoring a positive decision by the judge. Please note also that cherry picking in that case, cherry picking of employees is possible in that proceeding. These advantages of this procedure are mainly publicity, even though it may be waived by the judge, the timing, and the loss of control by the board in favor of the judge and of the trustee appointed by the court. To conclude, let's summarize the 5 key takeaways of these presentations. First, the leeway of the boards shrinks close to the over-indebtedness of the company. Second, the sale of assets is a restructuring measure which is available to the board to generate cash. Depending on its magnitude, the transaction should be submitted to the general meeting of shareholders. For a distressed transaction, finally, as any other standard transaction, has to be conducted with M&A best practices and business judgment rule. And finally, judicial moratorium has constraints, but offers, in our view, good protection of directors' liability for a distressed transaction. Thank you very much for your attention. And it is my pleasure now to pass the floor or the screen to Emmanuel for the second presentation.
Thank you, Jean-Luc. Thank you once again. And a warm welcome from my side to everyone who's joining us on this cold winter afternoon. And thank you all for being here with us today. When I was writing an article about distressed M&A in Switzerland just over a year ago, I wouldn't have thought that this topic would gain such relevance in such short time. And now we know COVID-19 has changed a lot, and this in particular. But first of all, what is distressed M&A about? Distressed M&A is about acquiring, selling, and financing troubled or insolvent companies. In Switzerland, we have seen, and these are the latest numbers I could get, in 2019, about almost 16,000 openings and close to 15,000 closings of bankruptcies, with a total financial loss created there or of more than 2.3 billion Swiss francs. So obviously bankruptcies have a certain importance in Switzerland, certain relevance, and based on that or through that, there is also more and more need for financial solutions in form of distressed mergers and acquisitions. Traditional M&A differentiates from distressed M&A that in that way that distressed M&A follows a much higher pace. It shows a shift in risk allocation. There is much higher risk involved, but also much higher reward possibilities. And above all, and also there is a much higher number of parties involved. So while in a traditional M&A transaction, we simply have basically buyer and seller, in a distressed M&A, we would see much more people on the table, starting with creditors, including and particularly banks, but also having the board and the management, which pursue different, not necessarily the same interest as the shareholders of the company and the company itself. We would have employees, we would have possibly suppliers, customers, etc. The latter not necessarily at the table, but possibly as interested buyers, they might also be involved. If we compare sort of the sequence of events in an M&A transaction, in a traditional M&A transaction, it's all very steady. It's a steady process, a well-known process. And if we compare that to a distressed M&A transaction, we rarely follow a common script. We see that things take a way which we wouldn't have expected, and that makes it very important to actually be flexible and to think out of the box. Buyers are often presented with incomplete facts. That's also, sorry. And facts which have been quickly assembled. The due diligence, which often in a normal transaction takes weeks, or at least a couple or 3 weeks or so, is often done in only a few days in a distressed transactions. So there is a general time pressure in such a transaction. And the buyer has because the value of a company basically deteriorates with time, still has an interest usually to wait a little bit longer until the price has come down, because the value of the company is even lower. I would like to split my presentation in 2 parts. One is, how does distressed M&A work prior to insolvency, and how does it work in insolvency? Prior to insolvency, we can talk about the asset deal, we can talk about share deal, and also financing options. In insolvency, it would be M&A in bankruptcy and in reorganization proceedings. In an asset deal, or the buyer has the advantage that he may focus his due diligence on assets which he intends to acquire. So this doesn't have to look into the entire company, but actually can focus on the assets which he's interested in. So that allows him to use the very limited time to actually concentrate on the things he's interested in. The strict liability scheme for directors, which we've heard of, has to be taken into the consideration. The directors will often face claims from creditors and or shareholders for depriving the company of its assets. So the directors are often hesitant to actually agree to a sale if the price which is being offered is not actually something which they would consider reasonable. And given the possible criminal liability they face, that's all the more important that they don't sell the assets below their value. If you look at the share deal, a share deal allows much quicker transaction, because there is basically, and it's more simpler because we have basically just the shares which are buying and not individual assets. We can avoid any regulatory or licensing issues. For example, if we're buying a company which is regulated, we don't have to make sure that the licenses and the authorizations are transferred from the bankrupt company or near bankrupt company to the new owner, but it actually stays with the old company. On the other hand, in a share deal, we're not only buying the assets which we like, but we take the company as it is. So that means it requires much more significant due diligence efforts. And again, we have only a very short time frame to do our due diligence. And what we also have to be aware of, that we won't get the shares as in a usual transaction with extensive representations and warranties, but actually with very limited reps and warranties. So that means that the buyer will not offer a high price, obviously, because he doesn't want to take too much risk. One way to combine the advantages of an asset and a share deal is a so-called hive down. What is done in this case is there is a new company being established as a subsidiary of the old selling company, which will absorb the distressed business. And then the target or the object of the sale is the new company. And that means that the risks related to the old company are not taken over, but just the assets which we want to have in the transaction as a buyer. If we look at financing measures, we can differentiate between equity financing and debt financing measures. And it is very typical for transactions which occur prior to a bankruptcy, prior to bankruptcy proceedings, that financing measures are taken. Typically, equity and debt financing are combined, because you would not get debt financing if the shareholders do not put money into the company, or new shareholders, old shareholders put money into the company, and you would not get anybody putting more money into the company if on the other hand, liquidity in form of debt financing isn't secured. So the two aspects are typically combined. In debt financing, we have already heard about that, and everybody knows that there has been this COVID-19 loan program, which has expired in the meantime, but still is obviously of relevance for those companies who have taken out such loans. If we look at the COVID loans, there have been about 17 billion, not million, but billion used, mainly through the very small loans, the COVID-19 loans up to 500,000 Swiss francs, and to a much lower extent through COVID-19 loans plus. The reason for that being that the COVID loans plus were much more difficult to obtain than the loans up to 500,000. From the experience I had with obtaining or trying to obtain COVID-19 loans plus, I must say it was not an easy way to get such a loan. We have heard about the restrictions on companies who have taken out COVID loans, and these restrictions obviously are still relevant for the companies who've taken out such loans. Main part, or the best known, is certainly that no dividends may be distributed or reimbursements of capital contributions made. And And also there shouldn't be any loans or refinancing of private loans or even shareholder loans. There shouldn't be no repaying of intragroup loans. That's particularly relevant if you have a group of companies. And there should be no transfer of funds made available under the COVID-19 loan program to affiliates outside of Switzerland. Again, this is also important if you rely on your subsidiaries or your affiliates abroad, and they actually rely on a funding by the headquarters in Switzerland. Also, as we've heard briefly, that we shouldn't, the COVID-19 loans shouldn't be used for new investments in fixed assets. I would like to just to point out these restrictions are pretty clear, I would say, but sometimes the detail is hidden or aspects which are not necessarily known or obvious to everybody. So if we're talking about or saying that no dividends should be distributed, this also means that could be possibly companies can be restricted to guarantee for affiliates, because guaranteeing for affiliates, if we're talking about cross-stream or upstream guarantees, these guarantees are actually considered due to the decisions of the federal court as being or regarded as dividend payments. So from that perspective, companies having taken out COVID-19 loans have to be aware that providing guarantees to affiliates could be problematic for them. And also about the no transfer of funds abroad, the question arose there whether it is problematic actually to make payments to group companies within the group. There is the opinion, or the prevailing opinion is that it is possible to actually make such payments, and fortunately the Swiss Federal Department of Finance has confirmed that view. So there is no problem if on intragroup agreements and actually covering claims on intragroup agreements. It's just a problem if you actually give a loan to an affiliate abroad. I would like briefly to go through some challenges and pitfalls of a distressed M&A transaction. We have, as mentioned already, a high time pressure, which makes it often very hard to actually get the information which you want to have to enter into a deal as a buyer. So for a buyer to actually make it interesting to acquire a company in distress, it is better if he begins to look into the company or at least into the sector before entering into such a process. And I've just been recently involved in a case where I know that the buyer has been looking at a target for a long time, actually starting 1.5 or 2 years ago. The target company was already in problems and was taken over by that time by someone else. Unfortunately, the company didn't get better, and recently the now buyer wanted to acquire this company, and in just about 6 days, the buyer managed to take over the business by agreeing a deal with the insolvency authorities, and that certainly wouldn't have been possible if the buyer hadn't known both the sector very well and also the target itself. Another aspect or challenge is that we have an uncertainty of the deal until the very moment of the signing. So there may be several parties interested. So if you are interested in actually purchasing a distressed company, you have to make sure or have to be aware that there may be other buyers who may outbid you. So time, again, is very important, and not only time, but also perhaps then making the best out of it, offering a price which will be attractive to the company prior to insolvency or to the insolvency authorities once bankruptcy proceedings have started. Another pitfall which has to be taken into account is that if a company is leveraged with credits, it is absolutely recommendable to agree on a haircut before you actually before the transaction is done and a new owner owns the business, because that's the only time where you can get rid of creditors. And if you don't do that, that opportunity has passed. One aspect which has been already addressed by my colleague Jean-Luc is obviously you want to make sure to keep the best employees in the company, the suppliers, and also the customers, because once they're gone, your business is gone too, and the target is not interesting anymore for any buyer. So that's something which is relevant for both, from both a buyer's and a seller's perspective. As just to mention briefly, there are obviously also prior to insolvency a number of aspects a number of alternatives actually to distressed M&A transaction. You see them. There are some which have a liquidity effect. Some of them don't. So it really depends on what your problem is. Do you have a pure problem of over indebtedness and have to clear your balance sheet, or do you have a lack of liquidity and actually need cash? Now I'm turning briefly to distressed M&A insolvency. We can split there between M&A in bankruptcy and M&A in reorganization proceedings. M&A in bankruptcy is very rare in ordinary proceedings. There are some transactions seen in summary bankruptcy proceedings, and the most efficient way actually to acquire assets or a company, or I should say a business, in bankruptcy proceedings is if there is an emergency sale. In ordinary bankruptcy proceedings, the creditors are in control and they can actually have the right to make higher bids. It requires their consent. So from all these aspects, it makes it less interesting actually to pursue a transaction with a company which is already in ordinary bankruptcy proceedings. There's one exception or one way out, and that's the emergency sale, according to Article 243 of the Swiss Bankruptcy Code. That means that the seller is a sale directly organized by the bankruptcy office, but that means that that is only possible if there is a deterioration expected of the assets, and if there are disproportionately high maintenance or storage costs of the assets which are in the bankruptcy estate. And the federal court has decided that assets subject to deterioration, that also covers companies which are deteriorating because they're losing customers, because they're losing employees, etc. As I said before, it's important to act fast, and that's actually where a buyer can step in and take advantage of such a situation and create, after all, a win-win situation for the bankruptcy estate and the buyer. Still, there remains a certain uncertainty with regard to whether the creditors have a right to make higher bids, but that's something which has not been clarified in jurisprudence yet. we have, in summary, bankruptcy, there is also a possibility to actually sell the company or assets in the summary proceedings. There is more flexibility as in an ordinary sale, and it can take place within 30 days after the creditors have been called. So a sale is typically possible within 6 to 8 weeks. But due diligence under these circumstances is often not very well possible, or at least only in a limited way. And again, here we have the risk that, and here it is actually a risk where it is clear that creditors may outbid a potential buyer at any time. If we briefly look at the M&A and reorganization proceedings, we have the phase 1 of reorganization proceedings, which is the moratorium, and we have in the phase 2 the actual restructuring or liquidation. We see sales being happening in both phases. In the reorganization, during the moratorium, companies actually remain in charge of the business, and that makes it a little bit easier to have a sale in that period, but it also requires a court approval, and it has to be in the best interest of the company, something which Jean-Luc pointed out already has to be observed, strictly observed by the board of directors. The buyer, and I would like to point that out again, we have heard that already. There is a possibility in all cases of such distressed transactions in bankruptcy, the buyer can actually pick the employees which he wants to take on board, and doing so obviously can limit his cost, but the provisions on mass dismissal and social plan obligation remain applicable in certain cases. I'm not going into detail there. The businesses are also sold in this phase, as already said, and in phase 2 in the reorganization proceedings. The moratorium does not require disclosure, not even to the creditors or customers. We've heard that. I won't again go into much detail here because that would be and in a reorganization, once a reorganization plan has been adopted, there is it is only an option if there is no urgent need to sell and the company disposes actually of sufficient assets to maintain its liquidity during the moratorium. If the company has a liquidity issue, this option certainly is not a viable one. So there are looking at distressed buying, looking at the pros and cons of acquiring a company or assets out of out of bankruptcy. There is no obligation to take on company's employees. The regulations regarding mass dismissal and social plan for employees are not applicable in case of an emergency sale, and the sales price cannot be challenged by way of avoidance action. On the other hand, we have no reps and warranties being answered, and the transaction is entirely at the risk of the buyer. If we look at the options, the sale may be part of reorganization plan itself. It may be merely the organization plan merely authorizes the liquidator to sell, or the plan may alternatively stipulate a hive down. All of these options must be approved by the creditors and sanctioned by the court. I would like to point out one aspect which is not necessarily obvious, and that is, even if you buy out a business, and I mean only assets, certain assets out of a bankruptcy estate, the buyer still faces the risk of tax liability. And the tax, that comes because there is a recent court decision saying that if you buy a business or as part of a business out of a bankruptcy estate, the tax risks for VAT tax and profit tax pass on to the buyer. And that's something which, again, is not very obvious and should be taken into account. Summarizing, I cannot stress it more, time is of the essence in any case. Distressed M&A offers often great opportunities, but there are many pitfalls which you should avoid, and to do so, it's certainly reasonable to look for good advice on these matters. Thank you for this, and I understand that we now have time for a few questions.
Yes, so we received a few questions. The first one would be addressed to Jean-Luc Chenot. It says that you said there are 3 levels of competencies for the sale of assets. What would happen if, for instance, the management of the board exceeds its competence? What happens to the assets sold?
Well, this is a big issue. Well, if the management has exceeded its competences, or the board even exceeded its competences, considering that the AGM should be competent, then there is a risk for the validity of the transaction, meaning that if a bankruptcy arises afterwards, then the transaction might be challenged by the bankruptcy state. So the risk is really related to the validity of the transaction as such. So it's a major issue.
Okay, thank you. We have a question to Emmanuel Detwiller. Can you please elaborate a bit on how generous and D&O insurances cover or not claims brought against directors in connection with bankruptcies?
Sorry, say that again. How D&O?
Can you elaborate how generous a D&O insurance cover or not claims brought against directors in connection with bankruptcies?
Well, to my knowledge, they are usually covering any acts which have been taken by observing business as a sound business judgment. Jean-Luc, do you want to have anything to add there, or?
Yeah, it's a hot question today, because you know that we speak about a possible bankruptcy pandemic, and there might have exclusions or limitations in case of bankruptcy. So the coverage might be an issue as such, depending on the terms and conditions of the insurance. We should remind that insurance is restricted in any case where there is fraud, of course, or even gross negligence. And insurance does not cover damage like tax impact, tax consequences, or social insurance consequences of the bankruptcy. So there is a risk which is higher for board members in case of bankruptcy than its standard, I would say, liability cases during the lifetime of the company.
And we have one more question to Jean-Luc Chenot. In your presentation, you refer to the best M&A practices. Where can we find such guidance on the best practices?
Oh, clearly by your lawyers. They should provide you with the best M&A practices. It's true to say that there are standards now in the way of selling assets or selling shares, in the way of deciding on the process of doing such transactions. And these standards have really become part of the due diligence of the board. But it's true to say that it's not really written in the books, it's more written in the experience of people.
Thank you. And one other question to Emmanuel Detwiller. Is the price in a distressed M&A transaction usually paid in once, or is there usually some earn-out payments to reduce the risk?
That really depends a little bit on what kind of distressed M&A transaction we're talking about. If we're talking about a distressed M&A transaction after the opening of bankruptcy proceedings, then we obviously, the seller, who is the bankruptcy office, will not accept any payments in installments. But if we're talking about a private sale, that can happen. At least theoretically, I wouldn't say it happens often, because typically the seller, in a case of distressed situation, wants to get rid of the assets and wants to be sure that he can save the money which he actually has been promised. And also, perhaps, I'm looking at Jean-Luc, but I think from a board liability perspective, the board typically in a distressed transaction would sell the assets a little bit at a, I would say, perhaps a little bit lower price than usual, and doing so, combining this with actually delaying the payment for the assets sold, or for the that obviously increases the risk for the members of the board.
I agree that if the board is facing a liquidity issue, then of course he will not negotiate earn-out payments. And if he doesn't negotiate an earn-out payment, he will probably have to discount the immediate cash payments for these concessions. So it's a trade-off. But in that situation, milestones, earn-out, and complementary payment are not really resolving the issue the board is facing.
All right, thank you. That was the last question we received.
So thank you very much, everybody. Many thanks for your interest and participation. And we'd like, on behalf of Keller Alsgarer, to address our best wishes to everybody. Happy New Year, and especially stay safe during this year. Goodbye.